Tuesday, November 30th, 2021, Maneco 64, home of alternative economics and contrarian views. So the chairman of the Federal Reserve is ready to pour some stimulus into the Omicron Punchbowl. That quote, of course, is a reference to a former chairman of the Federal Reserve, William Martin. And this is what he said: the job of the Federal Reserve is to take away the punch bowl just as the party gets going. That is, raise interest rates just when the economy reaches peak activity after a recession. So, of course, Jay Powell and all the other central banks around the world, they've forgotten about that dictum from William Martin, of course. And it shouldn't be surprising to any of you that this is happening. I even spoke with Mike from Rethinking the Dollar in our Mike and Mario show, the last Mike and Mario show. And the news had just come out about this new variant. And at the time, they were calling it new. And I said, well, they could use that as an excuse. New stimulus, new QE, right? But of course, they've changed the name, but it's still the same story. And from studying history, many books, as you know, and most of you or a lot of you have read the books I've recommended. I won't go into it here, but we know that once central bankers and governments go the path of hyperinflation, and yes, we have to look at inflation as the creation of fiat currency and credit out of thin air. It has become hyper, I would say, in the last 18 months. There's no way out of the inflation or hyperinflation. They have to keep inflating. And that's why I said, or I have said sometimes in the past, that yes, they're announcing that they're going to taper, that they're going to raise rates next year. It's always next year. But they could very easily find an excuse not to. And there we go. Another excuse not to. And yes, they will never be able to bring that balance sheet back. Let's say back to 800 billion. That's what it used to be before the '08 crisis. And I'd also say to all of those out there who still think that QE is deflationary, you have to listen to best evidence, because John Titus explains how the monetary system works, how there's two monetary channels. There's the official wholesale reserve channel, money supply, or he calls it reserve. That's where the central banks or the Federal Reserve or the Bank of England interact with foreign central banks, foreign governments, the US Treasury, and commercial banks. Those are called reserves. And the first leg of QE back after the '08 crisis kept a lot of those reserves within that wholesale market. But he goes on to explain why now a lot of those reserves, a lot of that QE is flowing one for one almost into the retail market. So what's the retail market? Well, that's when the commercial banks create loans, and the loans become money for non-financial institutions, for companies, corporations, and for us, of course. So I highly recommend that. Wake up. QE is inflationary, not deflationary. Have you seen lower prices in the last 10, 15 years? I haven't. And by that I mean for the cost of living, not a particular item, of course. So before we look into this new Omicron Punchbowl and the stimulus, I just wanted to play a clip here of when Ron Paul was still a congressman, and he was interviewing, or he was asking questions, really. I think it was the semi-annual testimony that the Fed chairman gives to Congress. And he was questioning the Citadel intern, Ben Bernanke. That's what Rudy Havenstein, and if you're on Twitter, I recommend you follow Rudy Havenstein. He's an end the feather. Rudy Havenstein, of course, was the head of the Reichsbank during the Weimar hyperinflation. But look at what Ben Bernanke said in 2010 in response to Ron Paul's, or listen to what Ben Bernanke said in response to Ron Paul's question about all the QE. Here we go.
Can you give me a rather quick answer on this? Do you have any idea what percentage the base should shrink or might shrink? Or is that something that you don't even want to address?
No, I think we would like to bring the balance sheet back to something consistent with where it was before the crisis, which means enough to accommodate Americans' demand for currency, plus a modest amount of reserves in the banking system, and that would suggest something under $1 trillion, I think, would be...
$1 trillion?
Or less, yes.
So there you go. 11 years later, we're approaching 9 trillion, and I think we could get very close to 10 trillion with the Omicron stimulus going into that punch bowl. As for fiscal stimulus, we haven't heard anything yet, but I'm sure it's going to come right behind the monetary one. So why am I saying that? Well, I saw an article yesterday, and this was from Bloomberg, an editorial by Marcus Ashworth. And there you go. Bloomberg is a mouthpiece, of course, for the financial sector. And it says, for central banks, Omicron is another word for reset. And reset is another word for buying time for policymakers caught between the end of stimulus and surging inflation. So let's quickly go through this here. Just the beginning of it. We don't need to really go through the whole article because you get the idea what's going on here. They're setting us up for more stimulus. They're going to stop talking about tapering and raising rates. It says, since the summer, it's not been a fun time to be a central banker. What with not so transitory inflation playing havoc with official targets and leading to some pretty terrible attempts to forward guidance. Yes, I'm looking directly at you, Bank of England. But the old lady of Threadneedle Street has not been the only major institution struggling to chart a clear course in the COVID era. Always blame COVID. Everyone's been unsettled since the global economy shut down, suddenly only to reopen with a jolt. It's a tough balancing act for central bank policymakers to appear competent. So yeah, they're not incompetent. It's just this pesky disease, right? The Omicron variant of the coronavirus is a get-out-of-jail-free card to play for more time by blaming acts of God. It is a Christmas present. Come early to be given a chance to buy some time or just to point the finger elsewhere. It will be interesting to see which central bankers this week will say their interest rate stance have been softened from the hawkishness forced on them by the surging inflation of recent months. So I'm going to stop at that. Yes, we saw German CPI came out at 6% yesterday. We saw Italian PPI coming out at almost 30. That's not surprising anymore, really. But what made me want to talk about this was there's another story later on Zero Hedge, and it says Fed Chair Powell swings dovish, blames Omicron uncertainty. So this is what it says here. But for one market participant in particular, it's a great excuse, especially after renomination as Fed Chairman. Powell's prepared remarks ahead of the Coronavirus and CARES Act hearing before the Committee on Banking, Housing, and Urban Affairs offered some insights into his next actions after a token shift to more hawkish positions by some Fed speakers. Here is the key paragraph. The recent rise in COVID-19 cases and the emergence of the Omicron variant poses downside risks to employment and economic activity and increased uncertainty for inflation. I think what he means by that is that their phony inflation data could drop a little bit from 6 to 4. It's still rising by 4. It's still robbing you of 4% of your hard-earned savings or wealth. Greater concerns about the virus could reduce people's willingness to work in person, which would slow progress in the labor market and intensify supply chain disruptions. So what do they say here, Zero Hedge? They say that uncertainty can mean only one thing when it comes from the Fed, backing away from the taper's current trajectory. And any guesses at when takeoff may occur? Takeoff, I think that they mean by what they mean by that is to take off of interest rates, raising rates. Well, that will be put back well into 2023, maybe 2024 now. Of course, this is truly amusing because only 10% of Wall Street respondents to a flash Deutsche Bank, I guess, DB poll, think Omicron will be a big issue at year end. So there you go. So what happens when an economy is shut down like last year and you keep pumping monetary and fiscal stimulus to it? Well, people keep consuming, keep buying, keep borrowing, like the economy is normal. And that's what's created all the disruptions. That's what's created all the rising prices. And according to Jay Powell, that's a good strategy. Of course, he's going to blame COVID for the inflation. He couldn't help it, right? And it looks like they're going to be doing the same. And this morning, we've got a little bit more scaremongering, this time from the WHO director, Tedros Adhanom, who I think was a Marxist agent in Ethiopia, Marxist rebel. It says WHO warns of very high risk from new Omicron coronavirus variant. Japan moves to ban foreign visitors to limit spread of heavily mutated strain. So there you go. The scaremongering is back on. And I'm not going to play it, but there's a clip of the South African president coming out and saying, we're not going to impose any constraints on the people who are not, and he said things are going to go on as normal. So, and that's supposedly where this thing came from. So that's all I have to say about that. I'm not going to play the clip. As I said, I don't want to be censored. But all we need to know is that, yes, all the talk of tapering, rate hikes, that's all going to go down the drain. They're going to probably get some kind of respite in terms of their phony inflation data. But you can bet that it's going to be Groundhog Day for inflation as well eventually, and for commodities, for everything. So with that, let's quickly look at where the markets are this morning. It's 8:15 a.m. London time. So where are we? Well, we got spot gold up $10 at $17.95, right near the highs. High's been 96, low's been 82. Of course, when the U.S. traders for the Fed and the Treasury start coming in, we could see gold and silver go back down. I think if there wasn't any gold or silver trading in the U.S., gold and silver would be multiple times higher, and probably we wouldn't be able to have this continued inflation of the system. But of course, that's just wishful thinking, right? So what about silver? Well, I noticed early this morning that silver was down quite a bit, but now it's up slightly. It's up 5 cents, just below 23 at 22.94. Low's been 75, the high 23.00. And here we go. The Dow futures is trading at 34,700. It's down just over 400 points, but it's been about 600 points down earlier overnight. So yes, we've rebounded a couple of hundred points. So yes, markets are under pressure, equity markets. The NASDAQ 100 future is down 0.5%, so it's outperforming the Dow. Dow is down about 1.2%. The S&P 500 is down 44 points, or just under 1%. So yes, stock markets, not surprisingly, going back down. Yesterday, I said in my live stream that I expected the stock markets to give back a lot of their gains from overnight yesterday. They didn't, but I guess it's a day late this time. So it doesn't bode very well for riskier assets, I would say. The FTSE 100 index is down 94 points, 1.3%, just above 7,000, which was, of course, the level we were back at the turn of the century, around 7,000. So it's done nothing, the FTSE, in about 21, almost 22 years. Currencies. Sterling is up 0.1%, so pretty steady, 133.28. The euro is up 1/3%, 113.29. The dollar is down 1/3% versus the yen, 113.09, testing the 113 level. And the dollar is down about 0.2% versus the Chinese yuan at 637.50. Aussie dollar down 1/3% at 71.20. And the dollar is up almost 0.5% versus the Canadian dollar, just below 128. And the Kiwi dollar is down 1/4% at 68.09. So not surprisingly, the general commodities are taking a bit of a hit here. WTI crude is down 2%, 68.28. Copper is down 2/3% at 431. Carbon emissions, we spoke about that yesterday. That's up 0.5%, 74.34. Natural gas is coming off. It's down 3.6% at 466. Does that change my mind about natural gas? No. I think we're going to see a lot of volatility. Medium to longer term, I think general commodities are going to keep going up. And fiat currencies, not just the dollar, are going to keep losing value versus hard assets versus real things. So to finish off, let's quickly look at where the bond market is. And not surprisingly, we're getting falling yields overnight. Treasury prices are rallying. We're at 1.45%, the 10-year yield, below 1.5. It's down about 7.5 basis points. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.